Welcome to Making Money. This is Matt McCall. Thanks for joining me. It's the 25th of April, 2023, a beautiful Tuesday here in Baltimore, Maryland. Got a big show coming up for you. We're going to talk about the market right now. It's kind of in no man's land. We're going to show you in a chart what that typically means in the past and what the next direction will likely be. We're also going to talk about the big bankruptcy over the weekend, Bed Bath & Beyond. What was it big? Were you expecting that? What's it mean for stocks? What's it mean for retail holders? What's it mean for meme stocks? And what's the lesson you should have learned from that? All that more coming up right now on Making Money. Most investors never touch this segment of the market, but according to the latest analysis from our team at Stansberry Research, this is the number one most important sector to pay attention to in 2023. And we're urging you to move your money immediately. You can stay one step ahead of the market and potentially unlock extraordinary gains just by understanding why this sector is set to boom. I strongly encourage you to read our analysis totally free today. It's all spelled out in a free report we just put together. Get the facts yourself. Go to hiddensector2023.com to get your free copy of this report. You can learn how to profit from the untapped potential in this hidden sector before it becomes widely known. Again, that's hiddensector2023.com for a free copy of our new report. Again, this is Matt McCall. Thanks for joining me. It's April 25th, 2023. It is a Tuesday morning. And we're going to talk about quite a few things I just mentioned here in the open. We're going to talk about Bed Bath & Beyond going bankrupt on Sunday. And obviously stock falling to pennies this week on that news. Crazy, I don't understand why people buy it. There's always, when stocks go bankrupt, we'll talk about it, but people buy it in hopes of what? I'll tell you the numbers, and trust me, you're not getting anything if you own the stock. You're not getting anything out of it. They owe people a lot of money, and it's not you if you own the stock. Unfortunately, hopefully you don't own the stock. But we want to talk about the market here first. The market's kind of been in no man's land here for quite a bit. And I'm going to show you here on a chart the consolidation that's been going on, because the best way to do is just to show you. And as you can see here in the chart, it's the S&P 500. And over the last couple of weeks, you can see here on the right-hand side, we've been in a very narrow trading range. And, as a matter of fact, 3 of the last 5 days last week, obviously 5 trading days in a week, 3 of the 5 days last week, the S&P closed less than 0.1% up or down. That's amazing. It's only been one day in April that's been greater than 1% up or down. And, it's the third straight week that we've seen a move of right around 1%. So we've seen this consolidation. But what I want you to see here in the chart is early February, we kind of did something similar, and then we broke down. And we're up against the same level. So the next move in the market, folks, if we break above on the SPYs, which tracks the S&P 500, the 417, 418 level, we're at 410 right now, let's call it. We break above that, it's a major breakout. If we hold 405, it's still good. We break below that, maybe we fall a little bit further. So we're right in the middle. We're in a consolidation phase. So my really advice here is for you to kind of sit on your hands and let the market tell you what it's going to do. I still think the market ends up much higher at the end of the year from here. Do we go straight up? No. The next Fed meeting is likely a 25 basis point hike. And that's going to be the driver. We have obviously another inflation number coming for this month at the end of the month, and that's going to be the driver. Those are the two main catalysts that will be driving the market more intermediate, longer term. Right now, this week, it's all about earnings. This is the biggest earnings week of the year for the S&P 500, reporting Q1 earnings for 2023. And if we take a look at earnings so far, there's really two ways to look at it. And I read a couple articles in the last 24 hours. Half of them are like, boy, earnings are actually better than expected and things are looking good. The other half is basically saying this is a dire time for earnings. And I'll give you both kind of views right now, and I'll let you decide. I'll give you my view. Of the results that just came out this morning. So this is just kind of looking at one day, but there's about 60 companies that came out this morning. 77% beat on the estimate for earnings per share. 73% on the beat on estimates for the sales for the company. And 5 of the companies raised guidance, 3 lower. This is out of 60 companies from this morning that I looked at. That's about in line with historical averages. You may say, well, how do they beat so much? Because most Wall Street analysts suck, number one. They have no idea what they're doing. Number two, most CEOs do what they call sandbag. Basically, they under promise and over deliver. It's like playing golf. You ever play golf in a tournament where you get a handicap, which means the worse you are, the more strokes you get. So if I have a 10 handicap, I get 10 strokes, or I get a stroke on 10 hardest holes. A lot of people like me have ego and be like, no, my handicap's low. It's low. I'm really good. There's people they call it sandbaggers. They come out and they say, okay, no, my God, my handicap's 20 when really it's a 10 because they get extra strokes and they end up winning the tournament. So CEOs tend to do that. They tend to sandbag. So we can look at it that way. Be like, well, earnings, for the most part, coming in about 3/4 are beating on the top and bottom line. That's what it's been so far through earnings season, right around that level. We can also say, well, it's about S&P earnings are down about 6.2%, give or take, over the same quarter last year. So earnings are falling. This would be the second consecutive quarter of negative earnings growth. So coming down. And it would be the largest year-over-year decline in earnings for the S&P since the second quarter of 2020, which we know that was the government-imposed COVID shutdown. So there wasn't much you could do there. So that makes sense. And that was down 31.6%. That was a bit of an anomaly. So again, you can look at it and be like, okay, we're coming in a little bit better than expected. And that's why stocks are holding up because we priced in over the last year that earnings were coming down. You can also say, well, they're still down over 6% year over year, second consecutive quarter, worst quarter we've had in nearly 3 years. That's not good news either. It's an earnings recession. So again, I think that's why you're seeing the market kind of go sideways right now because we have a lot of people that are deer in headlights. I literally just got off the phone with a money manager and asked him about his clients. And what he shared with me was a lot of people are doing well in the market this year. They're up because a lot of stocks are doing well, but still very hesitant. They still think, the next shoe's going to drop, that something's going to happen, whether it be the fall of the US dollar, whether it be more geopolitical concerns, whether it be an earnings recession, whether it be inflation picking back up, the Fed being overly aggressive. So many things out there can happen. But again, as I say all the time, I've been saying this for years. When I was a young buck on Wall Street, an old timer came up to me and told me something that I thought was, I've never forgotten it. It's been 20 some years. That every single day, and I'm sure he's long past, he was old 20 years ago. Every single day that he used to come to the New York Stock Exchange, he said, I could have a number of reasons, tens of reasons why you should not invest in the stock market today. And what happened over the 50 plus years he was on the New York Stock Exchange was one of the greatest wealth creations in the history of the world. So again, we can make up a lot of reasons why it's not going up, and that's not going to change. There's always going to be negativity out there. So Bank of America came out, and I thought that I don't like to talk about the headlines this much, but this is something that caught my eye. This was yesterday. It says Bank of America comes out and they say buy stocks because everyone hates them, is what they said. Even though their strategy team at Bank of America believes the S&P closes the year at 4,000, which is about 3% below today. So why would you buy stocks if anything's going down? They think it's a tactical opportunity that they can make money in second quarter. So basically trading it. And also the second quarter is a month over, isn't it? Or almost a month over. Or no. Yeah, almost a month over. So they have an indicator they looked at. And this is what my point I'm trying to get at. It's called the sell side indicator. It measures the portfolio allocations on Wall Street, meaning are they in bonds, stocks, cash, etc. It shows right now that stock allocations at 52.7%. That's down about 7 percentage points from the high of 2021. And it's not far. It's only about 1.3% from what they call a buy signal when it gets so low that it's contrarian buy signal. And I'm a contrarian. You all know that when everybody goes one way, I'm the guy going the other way. And I wasn't always like that. I didn't live my life like that at all, my entire life. But in my adult years, for the majority of time, if everybody's going into that restaurant over there and the line's around the corner, I'll tell you where I'm not going. First of all, I'm too old to wait in lines, but I'm not going in there. I'm going to go to a little corner place that I'm going to give a shot. And that's how you have to make money in the stock market. You need to do that. Bank of America also came out and said venture capital and private equity firms right now are sitting on $2.2 trillion in cash. They call it dry powder. Folks, I'm telling you, there are so many indicators out there right now showing just how negative people really are. And That's one thing. That's the psychological aspect of it. What about the aspect of truly looking at the numbers? It's quantitative. The amount of cash on sidelines is still absolutely enormous. The amount of underinvestment in stocks through Wall Street is still huge. The underallocation to equities, folks, is still extremely high. It can stay like that for months or another year. It can stay like that for a long time. But I will guarantee you this, at some point, that money has to come off what we call the sidelines. It's okay now because you can find savings accounts making good money. What's Apple Pay? 4.1%, something like that. You can find areas to get some money in cash so you're not getting crushed. However, it's still below inflation right now. But people pay money managers. They pay experts. They pay people in my field, not to say buy or own cash, to give ideas, to invest their money. So eventually there's pressure. And when that pressure happens and that money comes in, it's simple supply and demand. That money comes in and pushes stocks up. There's more buyers than sellers. It's very easy to figure that out. So again, I just wanted to kind of show you where we are in the chart, where people are right now, what they're feeling. And I'll tell you, people are feeling still kind of, they're not overly bullish, not overly bearish. But when this does switch to becoming bearish, folks, I'm telling you, it's going to happen fast. And I hope you're ready. And I hope you're buying quality stocks right now, quality long-term companies right now, getting ready for when that happens. Again, it could be tomorrow, it could be a year from now. I don't know. We'll know more when it happens, but it will happen. And I think you should be prepared for it to happen at some point. Well, something you should have been prepared for a long time, in my opinion. I mean, we all knew this day was coming, did we not? Bed Bath & Beyond, symbol BBBY, filed for bankruptcy, Chapter 11, bankruptcy on Sunday. The fact that it actually made it this long, the fact people gave them money and lent them money and invested in this company over the last couple of years blows my mind. This was one of the most obvious end of a stock I've ever seen. I'm talking about some other companies that could be on the brink of bankruptcy as well. But, you know, Bed Bath & Beyond, founded in 1971, went public in 1992. This company, you know, I almost feel bad because, there's a lot of people that worked at these locations. When they filed bankruptcy on Sunday, they still have 360 Bed Bath & Beyond locations, 120 Bye Bye Baby, which is obviously the children's part, the clothing part of that. But I got to tell you, folks, I mean, it's sad because there's people losing their jobs. There's a lot of people. There's executives. There's salespeople. There's people working all over the place for this company. It's going to put a lot of people out of business. So what happened here at Bed Bath & Beyond? They had an activist investor who came in 2019 to control, and they tried to go the Target route because this guy they put in charge took to help Target kind of turn things around. And what's called a private label. And that means instead of selling, I'm just using a name, a Keurig coffee machine, you make your own, put your own stupid name on it. So you make your private label it. And that really kind of put people out, took them away because they went there for certain brands and they kind of ruined that. So, the next thing you know, sales were down. Then we had the whole COVID thing happen and blew up. But let me show you a chart here. This is Bed Bath & Beyond. I mentioned it went public in 1992. This is what if you invested $10,000 in a day, Bed Bath & Beyond went public. Your $10,000 would have turned into about $750,000 from 92 to about 2014 when it hit its all-time high. And then obviously down, this was 3,000. This was as of last Friday. Obviously now it's down to zero basically, or a couple bucks, whatever it might be. But it's pretty amazing. I mean, this was a huge winner. This was a very successful company. And you can see the spikes on the right-hand side in 2020. That was obviously due to the meme stocks. And I want to talk about meme stocks here in a minute, but again, let me show you a chart here of Bed Bath & Beyond, the true chart of Bed Bath & Beyond here. Again, you can see from 92 all the way up, and the huge spikes from $4 up to nearly 55, all over the place, all meme stock in here on the right-hand side. And, I don't want to bash people for the meme stock stuff. When it was going on during COVID, it was a weird time. I had a lot of time to read and a lot of time to research and do investing on my own. And I'll tell you, folks, I viewed what went on there with the meme stocks in two very distinct ways. One, this whole Bed Bath and Beyond meme, GameStop, AMC meme stock bonanza that went on. I actually thought it was good. Just part of me thought it was good, and the reason I did is because it was kind of gamifying the stock market and getting a younger group interested in investing and interested in the stock market and pushing them to open brokerage accounts. I thought that was great. The downside to this was they're buying shit companies like Bed Bath and Beyond and GameStop and AMC. And not only are they buying them, they're buying them near highs and spikes. And if you bought then and then next thing you know, you're down like, oh shoot, I can't sell now. I'm down so much. I believe Bed Bath and Beyond, it's going to zero. You're out everything. And that's a tough lesson to learn as your first foray potentially into investing. That being said, folks, my first foray was in the late 90s. I was still in college. And I've told the story many, many times. I'll give you the 60-second abridged version. My grandma had passed away a few years earlier, maybe a year earlier. My father had some money, gave me some money to basically get my head on straight and get the hell out of college and get a degree. Double the money in investing in internet stocks. I remember one was CMGI, a couple others that aren't around anymore. And I thought I knew everything. Similar to the meme stocks. It's just too easy. So I changed my major to finance, which was a great move. So that helped me. And within months later, I lost basically all of it because I didn't have any plan. I thought stocks go up every day. That's what happens. And I think the same thing happened to people in meme stocks. Luckily, I took that and I took it as a challenge to educate myself and get better and learn how to invest in stocks for the long term. So I hope people out there listening that may have been turned off by meme stocks and turned off by what happened and are anti-Wall Street, give it another chance, because I will tell you, for the average person, and most of us will fall into that category, for the average American, the stock market, investing in the stock market over the long term, consistently, is the number one way to become wealthy. It is, and nobody can argue against that. Put real estate up against it. You can put everything else up against it. It is the number one way for the average person, because the average person doesn't have 20% to put down for a big real estate deal. Just don't. So, and their money's tied up. This, obviously can pull your money out. So to me, again, you don't want to let what happened here ruin it. That being said, there's a lot of meme stocks out there. I want to talk about a couple of others that may join Bed Bath & Beyond in bankruptcy. So real quick, who wins out of this? Let's look for investment opportunities. Maybe a company like Wayfair, but let me show you a chart here of Wayfair. Stock's gotten crushes over $300 a share just in 2021, down to $36 a share. I bought stuff from Wayfair, and I'm never really happy with it. I think a lot of it's junk, honestly. So I don't know if they win. Could it be Amazon? Sure. I think Amazon can win anytime something like this goes out of business. Some people are talking about Williams Sonoma owns a couple other businesses online, more kind of furniture related. But again, that stock struggled as well. So I don't know, honestly, if there's going to be any direct winner here. I think if anything, I had to pick one, probably Amazon. But I don't think you'll see a material move in Amazon based off that. But that could be potentially one winner. And, I was going to talk about some of the guys who made a lot of money in this, but I think that's just kind of a kick in the gut. Or a punch in the gut. We don't have to do that. So what's next? Who's next, I should say. And, the two that come to mind, folks, and we're going to take a look at charts right now. AMC. Trading at $5 a share right now. And, let me show you a longer term chart. This stock was down to what? $1.90, below $2 in late 2020. And it went up to over $70 in the meme run up. And now we're back down to $5. Could they hold on? Sure. People are going back to movies again. I could see that, it holding on, but, and again, none of this is advice to go out and short these companies or do anything or buy puts on them to take advantage of them going bankrupt. And I'm not saying this because I know something. I'm just saying there's a potential for a company like this that burns a ton of cash that they could be in trouble. And the other one, obviously, is the other big meme stock, and that's GameStop. This stock was basically dead in the water in 2020. even before that, go back to 2019, shot up to $120 a share during the meme craze. We're still at $19 a share right now, believe it or not. But that's another one I think you want to keep an eye on. One of them, another one that really recently just filed for bankruptcy is Party City. You can see here, look at Party City. Obviously it was a big meme stock. It went from pennies to $11, back down to pennies. Now it's trading. It's a bankrupt stock. Another one that wasn't really a meme stock, but this was a SPAC that went public in 2021 called Boxed. I remember this company in New York City. They used to send you big box stuff. And again, it looks like this is filing to go bankruptcy as well. So again, I'm not saying, go out and short these stocks, buy puts on them, whatever. But, there's a couple of stocks I have here. I think the list is actually pretty long of a lot of companies that could be facing imminent bankruptcy, similar to we just saw with Bed Bath & Beyond. So, in this show, there's three pillars of it. And number one is education, and we're about to do that. We didn't get to it yet. And the other one is obviously have some fun. My energy is a little low because I just had 2 weeks of laryngitis, and so I apologize if I'm not yelling and getting as excited as I normally do. Plus, I don't want to get overexcited about a company going bankrupt because again, people lose jobs and somebody owns those shares. So I don't want to revel in somebody losing money or losing a job. But there are lessons here. And of course, the third one is making money. That was making money. But the most important is education. And two kind of things I want you to think about here. One is the get rich quick mentality will destroy you. It just doesn't happen. Sure, there's a dime a dozen stories on the internet, people getting rich quick. I doubled my money. It was a little bit of money, but when I had it back in the late 90s, did I become rich? No, but it was nice, a lot of money for a college kid. But I lost it all. You don't get rich quick. It takes hard work. It takes patience, fortitude, and you just have to let time play out, especially in the stock market. And the meme stocks, you heard stories about people doubling their money in minutes and quadrupling their money buying options and all this stuff. But the amount of people who lost money, it's just so much greater than people who made money. It stinks. The other thing is invest in companies you believe in long term. If I were asked people right now who bought GameStop or AMC or Bed Bath & Beyond, if they believed in that company long term, if they believed in it, it's going to be around 10 years and be a better company, I guarantee 99% of people said, absolutely not, it's a shit company. Then why are you buying the stock? Because you realize, folks, when you buy a share of a stock, you're an owner of that company. You're an owner of that company. Why would you want to own something that you think shit? So when you buy stocks, any stock, ask yourself, look in the mirror and say, do I want to be an owner of this company? And if you can say yes, hit the buy button. If you can't, ignore it. It's not a company for you. You have to believe in it long term. If you don't, folks, you're going to second guess yourself. Buyer's remorse. Every time I'm frugal. Every time I buy something over a certain amount, I have buyer's remorse. All the time. It could be a pair of sneakers and I have buyer's remorse. I put them on. In the store, they look great on me. I get home, I'm like, God, these look stupid. Can't believe you spent the money on this. You're invested in. You put the money down in that stock and you must stay in it. Or no, I shouldn't say you must stay in it. You must believe in it. You can always sell, but you must believe in it. So get rich quick doesn't work. Invest for long term in companies you believe in. All right, folks, coming back Thursday. We got a great interview lined up for you on Thursday. Hopefully the voice is a little bit better every single day, but I'm about to go rest it up right now. I got a couple meetings and I'm going to sit there and be a listener for the first time in a long time. Thanks so much for listening, for watching. Have a great rest of your day. We'll be back Thursday. Again, great interview lined up. I'm Matt McCall, and that was Making Money.
Opinions expressed on this program are solely those of the contributor and do not necessarily reflect the opinions of Stansberry Research, its parent company, or affiliates.